Hi, everybody. This is Tom English. I'm the executive editor of the Southern Illinoisan in Carbondale, and we are here for our monthly video cast here with England in English. I would say that I'm here with David England, but I am not here. I am there with David England. David is in his home. I am in my home. We are practicing social distancing right now. And we're here to talk to you a little bit about the market and what's going on. And I'm sure there's a lot of questions out there. It's a very volatile time. So, Dave, how you doing today?
I'm well, sir. And yourself?
I am pretty pent up. I'm not a person who sits still very well. So this has been a challenge for us, but, we'll get through this.
I know the words of that song, Tom. And we will. We're going to come out stronger on the other side.
Yes, we will. So let's get right to it.
Let's hit it.
I want to talk about what's going on, especially in the markets. From the last time we talked last month, you stated that the Dow would see 25K before 30K again. So how did you know that was going to happen?
Didn't know it 100%, Tom, but back last summer, I started seeing different signs with the advanced studies that I do with technical analysis and these kinds of things. I also started watching the amount of money that the Fed was already putting back into the system. They weren't saying it was quantitative easing, but it was quantitative easing. And I saw this major warning signals. And that was about in July and August. And that's whenever I reached out to you and said, hey, you want to kickstart the column again? Biggest reason is I just like to prepare people for what's coming ahead. And by the way, I just want to say I had no idea the magnitude of this. I could see that there was major weakness coming ahead, but no idea about this magnitude. But mainly due to the fact that, yes, at that point in time, that was on a Monday, and 3 days later, the Dow dropped right down to 26,000, 25,000. So it had to do with the advanced studies that I do in these kinds of, from a technical aspect, had nothing to do with fundamentals.
I remember last time we talked, that's really when the so to speak, it hit the fan.
Yes, sir.
Later that week is when it really started. So where from here, where does the market go from here?
Well, Tom, one of the things that I'm definitely looking for is I'm looking for a test of the previous lows. And I know a lot of people that are calling for a V-shaped recovery. I don't see that at all, because number one, we aren't just fighting the effects of the coronavirus, and it's just horrendous. What we're also doing is we're fighting the aftermath, just beginning of the containment. And now the containment aspect of it is going to hitting the market even harder than the effects of the coronavirus. So I see a test of the previous low. And then from there, I don't see a V-shaped recovery. And, you edited a piece that I sent. And by the way, I appreciate the permission to do an extended version this Sunday. And one of the things that I am doing is I'm doing a nuts and bolts approach to show our followers, our readers, the different phases of a bear market. And so you read it, you edited it. Was there some things in there that got your attention?
Yeah, there was. It was definitely interesting to read, especially someone who doesn't have the background that you have, and how it kind of works. It's very interesting to see.
Okay. So anyway, as I see continued weakness, we're going to have waves up. We're going to have waves down. This thing's not going to work itself through overnight. Whenever a couple of weeks ago, whenever I did the analysis of the 2003 pullback, and also step-by-step analysis of the 2007, 2009, I also diagrammed the different wave patterns in that. Those things didn't stop overnight. It took a year and a half for one and almost 3 years for the other one to work its way through. But whenever I say this is going to be extended, there's going to be many, many opportunities along the way for us and for our viewers and readers. So it's not all negative.
Sorry, it's hard to communicate here when I'm looking at you on a screen. I can usually feel a lot better when you're sitting next to me. So are we in a recession right now?
Well, technically, we can't be in a recession until we've had 2 quarters of downturn on the GDP. But by the way, so that's the technical definition. Officially, we're very much in a recession, and we're in recessionary times. So for the person that's in that question, yes, we are in a recession. And Tom, one of the things which I'm looking at is if the effects of the containment continued to go on to several months, then we definitely have to be serious about this. Not that we aren't serious now, but we need to be taking a look. Is it going to get into worse terms than recession? And the jury is still out on that. You know me, I'm a very, very, very positive person. But this containment and the effects from it can be very, very damaging to our economy. The good thing is before this thing started, our economy was extremely, extremely strong, and we had a whole lot of people working. So hopefully they were able to put some of that back in the nest egg that they'll be able to weather this storm. So are we in recession? Yes, sir, we definitely are.
So this question comes in from one of our readers, and it was posted on Facebook. But this the question is, this person watched a man from the Federal Reserve say on 60 Minutes that the Fed has the authority to print unlimited amounts of electronic and hard currency. During the banking crisis, they printed money in massive amounts, but we did not see inflation. Is this going to be different this time around?
Well, and by the way, that came from not only a reader, but also a small business owner. And we really appreciate Mr. Landis that sent this question. One of the key things is, remember, when the Federal Reserve floods the market with money, a lot of that they can take back in whenever times gets good. They have many, many tools to keep inflation from coming down. And one of the biggest reasons why we cannot have inflation, they must keep the interest rates down low, Tom. Why? So the question is, why? Because with so much borrowed money, by law, we do not have to pay back the national debt, period. But we do have to pay back the interest on it. So you can imagine what would happen to that interest payment. Before this started, there was about 7 cents out of every dollar on the federal budget that went to interest alone. So now with all of this increase of the Fed's balance sheet and these kinds of things with the Treasury, the interest rate must be kept low, or that thing's going to, so it'll counteract the trillions that are being printed, so to speak. It's a Treasury term. And it's got to counteract what the interest rates are. So by hook or crook, they must keep that interest rate low, or then we see even more problems on the other side.
Is it closed firmly, and we've all seen the gas prices. Well, maybe you haven't seen the gas prices this week if you're staying inside, but is it closed firmly below $20 on oil, likely to cause another rapid drop in the Dow? And does oil then start to lead the market more?
Yes, I believe this question came in from Mr. Jordan. I believe he's from Arkansas, trades oil and these kinds of things. And this question came in 2-3 days ago before we had the developments in oil where it popped up. But the question, and I'm going to answer the young man's question, a crack under 20 will definitely be even more devastating to the market. Matter of fact, a crack, when we talk about oil, let's talk about West Texas Intermediate crude. That's pretty much what we deal with. When you hear Brent, that's what the Europeans and also the people in Africa deal with. We deal with West Texas Intermediate crude. With that being said, the break-even point for many companies is $40 a barrel. So whenever it drops underneath 40, that gets to be extremely devastating. Whenever it breaks underneath 20, that can be just outright disastrous. And I know a lot of people are saying, well, I really don't care about oil because I'm paying for a lower price at the pump. Well, we start to care about it when we have a relative that works for an oil company and it goes bust. Or we have a wife or an aunt or an uncle that works for it and they get laid off. There's not, or it would be hard pressed to find any industry that doesn't have a link to oil, whether it's transportation cost or these kinds of things. So to answer Mr. Jordan's question, yes, if we should break underneath 20, and I play oil, I'm looking for it to go back down and test. And then there's many, many things that I'm taking a look at to invest in when it goes back up. But yes, if it should go back down and test 20, I wouldn't be surprised to see it go down and test 16 or 15, Tom.
Ooh, that's not
well,
good.
If you think, how could it do that? Well, a while back it was at 60.
Yeah.
And then people said, well, it's going to stop at 50. It's going to stop at 40. It's going to stop at 30. Well, we're in unprecedented times in many things, including oil.
So can you talk about how to go about dividend investing for long-term growth?
Yes. I think Mr. Flaherty from, I believe, out in Arizona sent this question, and I appreciate everybody sending in their questions for this. Dividend investing. And one of these days, I'm going to sit down and write a column on the 2 ways to make money in the market. 95% of the folks out there focus on making money on buying low and selling higher. But that's how the market is designed. But there's another way that many of us take a look at, and that's through dividends, to see how many shares that we can build by having a high dividend fund or having high dividends reinvested at no commission back into the original security. So whenever we talk about dividend investing for long-term growth, what we have to have higher dividend paying instruments. And a lot of times that's your funds. Okay. We also have to have that where it can be reinvested. Each dividend can be reinvested at no commissions so that you build up your number of shares. And then it also needs to be reinvested, which is no problem these days with zero commissions. So yes, I am big. And by the way, I have a whole strategy that's called my garden growing strategy, where I pick high, in my analytics business, we follow these and we track them. We pick high quality, high dividend funds so that they're funds, so they're diversified instead of individual companies. A diversified fund may have 2, 3, 4, 500 different securities in it. So we have that somewhat safety feature. And a lot of those that I invest in pay monthly, not quarterly. Tom, I don't know about you, but I'd rather have a monthly paycheck than a quarterly paycheck.
I would enjoy that.
So on a monthly basis, we get to those dividends, they go back in and buy us more shares. And this is one of the things, matter of fact, I came up with this strategy whenever I was recovering from kidney cancer years ago. And at that time, we had 10 years of a market that did not average 8%. Matter of fact, in that 10 years, you probably would have lost money because of not because of the compounding, but because the price went flat for 10 years. So yes, that's a very, very important strategy that more people should think about. And probably maybe June or July, I may go ahead and do a special report on that.
So you talk quite a bit about closed-end funds. What are they, and when should folks buy them?
Closed-end fund, well, they're a mutual fund. Most people are familiar with open-end mutual funds. And whenever you're buying those or being sold by a broker, many of those have 4, 5, 6% open-end, front-end commissions. A closed-end fund is a fund that has a number of securities in it, and it is closed in, so it doesn't change that much since it has its IPO. But here's what makes it unique. And one of the reasons why most people haven't heard of it is because if you were sold it by your broker or your advisor, it's only a commission. It's not a 5 or 6 or 7% commission. So it's a mutual fund that trades like a stock. Plus an open-end fund that, like a lot of people have, you buy those from the company, American Funds, Van Kampen, these kinds of things. Closed-end funds, they're traded on an exchange. When you buy your open-end funds, you have no idea about the volume, how much is being bought, how much is being sold, because since it's not on an exchange, it's not being reported. And there's nothing illegal or anything. There's nothing wrong. There's a lot of people who make good money with open-end funds. But with closed-end funds, then what we have is it's on an exchange. We can do volume. That gives me the aspect of chart it like everything else. And then the bottom line is I can see what the institutions are doing, buying or selling, and that goes into my equation on whether or not I'm going to buy them or take profits with them.
So we've heard a lot about the stimulus money and the checks that are going to start coming here shortly. But one reader wants to know, should I invest $1,000 of my check when it comes in?
You know, I think that's probably one of the most common questions that's being asked at this point in time. One of the first things I would do is I would tell people, if you got a lot of high interest debt, maybe some of those specialty credit cards that you're paying 20, 22, 24, 26% interest on, knock those out first. But if somebody has their debt taken care of, now I'm not talking about the mortgage debt or something like that, but I mean, if you have that unheard of stupid debt, get that taken care of. But before I would invest $1,000 from a stimulus check, if you're just a newbie to the market, then at that point in time, fund your account. Fund it with an online broker where there's zero commissions. And have patience. Most of the time, people, when they fund their account, they've bought something before the end of the day. Invest in education. And Tom, one of the many, many advantages that we have today compared to 10 to 15 years ago, with all of the online brokerage houses, they are constantly trying to build up their market share. And one of the ways that they're doing that is through quality education, free quality education from the brokerage house. So it gets back to that old age-old proverb. I don't know if it's the Chinese, if it's the Hebrews, or whoever. Don't give a man a fish, teach him to fish. So first, and by the way, that proverb has a lot of wisdom to it. Learn how the markets work. Then and only then start to invest it. Now, since we got that out of the way, diversify. If you have $1,000, divide it into 4 and then choose 4 different funds, not individual companies, because you also have to do risk management. 4 individual companies and have those dividends reinvested so you can build shares. So that's, that question that came in, that's a pretty good problem to have some extra money. And I really get excited to see people wanting to do something with their stimulus check. And I realize a lot of that has to do with the government wanting to go in and spend that because of the 7 times turnaround rate. And yes, we need to, and there won't be a problem. There'll be people spending their stimulus check. But this question came from a particular follower. And so that's why we're going to answer their question the way that we did. First, education. And then don't get in any hurry. Take a look at funds, hopefully things that pay a monthly dividend, and have those reinvested so that you see how quick you can build up the number of funds, how many shares you have, and don't worry that much about the price.
All right, David, anything else you want to talk about today?
Well, we've talked about where the market goes from here. Calm heads prevail. We're going to see some things. Tom, this has been one of the quickest sell-offs I've ever seen. Okay. And there's a lot of people out there that are hurting, no doubt about it. So this resorts to, and of course, we're answering questions about the market. What do? We need to make sure our family's taken care of. We'll make sure our neighbors are taken care of. Go out and adopt a family that's maybe not working. Help them out. But one of the things that I definitely want to do is, number one, I appreciate this opportunity to be able to speak. I appreciate our followers that take the time to listen to us and watch us. I thank you, Tom English, for trusting in me to put my opinion on the tables. And by the way, we've been doing this for how many years?
Oh, I don't want to put a number on that because I can't even remember. I'd say at least 3 or 4.
I've never lied to you or the readers, and I don't plan on starting on that now. So we're going to put, no matter how tough, we're going to put truth on the table. And then I also want to thank Tom Mann. Tom is the go-to person in our Southern Illinois market on teaching people how to podcast. And he was over here to help set me up. I know one thing, if it weren't for him, you and I wouldn't be doing this today, and we would not be breaking the rules. If we couldn't do it electronically, we wouldn't be able to do this today.
Yep.
So I thank a lot of people that's involved for us to be able to do this. And the bottom line, calm heads prevail. We're going to get through this, and we're going to be stronger on the other side.
I hope everybody out there is happy, healthy, content, and most of all, stay healthy, and we'll talk to everybody soon, okay?
All righty. Thank you.
Thank you.